Today, we would like to explain about Japan's pension systems. We have two main systems that are very different from each other: Kosei Nenkin, which is the employee's pension insurance, and Kokumin Nenkin, which is the national pension insurance. The Japan Pension Service provides detailed information about both systems, but today we will explain the key differences and why they matter. These systems have very different implications for your future security, so it's important to understand how they work. Before we begin, we should mention that you can find more information from the Japan Pension Service, including English language materials and pamphlets, at the QR codes, also linked in the description below. Also, if you need assistance or have questions after this presentation, you can contact us at hotline@genu.cc. That email is also listed in the description below. Let's start by looking at who qualifies for employees' pension insurance. The key criteria have changed recently, and this is important to understand. For larger companies, those with 51 or more employees, you need to work at least 20 hours per week to qualify. For smaller companies, you generally need to work 30 hours or more per week. The company structure is also important. Even if you work at a very small incorporated company, which is one employee, you must be enrolled if you meet the hours requirement. For unincorporated businesses, they need at least 5 employees before enrollment becomes mandatory. This October's changes to these requirements are significant because they mean more workers will now be eligible for coverage. This is particularly important for those working at medium-sized companies. Now, there are some important additional points about enrollment that we need to explain. If you leave your job, you can actually continue your enrollment in the employee's pension system for up to 2 years. This is a significant benefit that many people aren't aware of. We also need to discuss how contract length affects eligibility. If you have a contract that's initially for 2 months or less, you wouldn't be enrolled at first. However, if that contract gets renewed, even for just another 2 months, you can be enrolled in the system. The key point here is that the system is designed to provide coverage for stable employment relationships, even if they didn't start that way. These continuation and contract renewal provisions show how the system aims to maintain coverage for workers, even when their employment situations change. It's part of the overall goal to ensure more workers have access to proper pension coverage. Now, let's talk about the national pension system. We want to make it clear who needs to enroll in the system. It's for anyone who isn't enrolled in employees' pension insurance. This includes self-employed people, students, and others who don't qualify for the employee system. There are several important exemption categories we need to explain: recipients of disability basic pension, recipients of public assistance, low-income individuals, full-time students, individuals under 50 with limited income, Japanese nationals living abroad. What's crucial to understand is that most of these exemptions aren't automatic. They require some procedure. You need to apply through your local government office. The details for each exemption category can be found on the Japan Pension Service website, and we encourage you to check the full explanation using the link we've provided, also in the description below. For anyone considering an exemption, we strongly recommend carefully thinking about the long-term implication for your pension benefits. While exemptions can provide temporary relief, they may affect your future pension amount. Now we want to explain about the premiums in these systems, because this is where we see one of the first major advantages of the employee's health insurance. The premium calculation is completely different between the two systems. For employees' pension insurance, premiums are calculated as a percentage of your salary. But here's the important point: your employer pays half. So, while the total premium rate is 18.3%, you as an employee only pay 9.15%. Your employer matches this amount. For national pension insurance, it's a fixed rate system. Currently, you pay 16,900 yen per month, and you have to pay the entire amount yourself. There's no employer sharing the cost. When you look at these premium tables, you might think the employee's pension costs more overall, but remember, you're only paying half. Plus, as we'll see in the next few slides, you'll get significantly better benefits under this system. The cost sharing under employees' pension is one of the key reasons why it's so important to be enrolled in this system if you're eligible. Unfortunately, some employers try to avoid enrolling workers to save money, but this really disadvantages workers in the long run. Now, we want to explain about the three main types of benefits available under both pension systems. At first glance, they might appear to be the same, but as we'll show you, there are crucial differences. Let's look at what these benefits are. First, we have the old age pension, which typically starts at age 65. There is some flexibility here. You could start receiving it as early as age 60, though with reduced amounts, or could defer until age 75 for increased benefits. Then, there's survivor's pension. This provides support for family members, particularly spouses, when someone enrolled in either national pension or employee's pension passes away. Finally, there's disability pension. This benefit becomes available when illness or injury, not caused by work, restricts your daily life or affects your ability to work. Now, you might be thinking, these benefits sound the same under both systems. After all, they have the same names and general purposes. But this is precisely why we're having this presentation today, to show you how significantly different these benefits actually are between the two systems. The differences in the amount and scope of coverage can have a massive impact on your future security. The answer to whether these benefits are the same is absolutely clear. They definitely are not. This is one of the most important points we want to make today. So let's explain exactly how these systems differ. At the heart of Japan's public pension system is what we call the basic pension, Kiso Nenkin. This is the foundation that all pension contributors in Japan receive, whether they're in the national pension or the employee's pension system. If you contribute for 40 years, this basic pension provides 816,000 yen per year. That's about 68,000 yen per month. But here's the crucial point. While everyone gets the basic pension, it's only part of the story. For national pension contributors, this is all they receive. However, for those in the employee's pension system, this is just the starting point. This fundamental difference in structure means that employees' pension enrollees are building towards a much more secure retirement. Understanding this difference is essential because sometimes employers might try to convince workers that the systems are basically the same, just with different names. They are not the same at all, and the impact on your future financial security can be substantial. In the next few slides, we'll show you exactly how these differences work and why they matter so much to your future. Looking at these figures from March 2023, we can see the real difference between these systems in practice. For national pension, the monthly benefits range from about 43,000 yen for those aged 60 to 64 to around 56,000 yen for older recipients, with an overall average of 56,428 yen per month. For employees' pension, the contrast is striking. Benefits range from about 74,600 yen for the youngest retirees up to nearly 160,000 yen for those aged 85 to 89, with an overall average of 144,182 yen per month. Looking at the maximum annual amounts for fiscal year 2024, we see an even starker difference. 816,000 yen for national pension versus 4,435,476 yen for employees' pension. Now, let's look at exactly how your pension amount is calculated. For national pension, it's quite straightforward. The basic formula takes the annual amount of 816,000 yen and adjusts it based on how many months you've contributed. Out of the full 480 months, that's 40 years. Looking at the actual numbers, if you contributed for the full 40 years, you'll receive 816,000 yen per year. With 35 years of contribution, this drops to 714,000 yen, and with 30 years, it's 612,000 yen. As you can see, the amount decreases significantly with fewer years of contributions, down to just 204,000 yen annually with only 10 years of payments. For employees' pension, the calculation is more complex. Unlike the simple national pension formula, it takes into account your salary history and length of enrollment. There's also something important to note if you continue working after starting your pension. If your combined monthly pension and earnings exceed 500,000 yen, your pension may be reduced. The final amount really depends on 3 factors: your salary history, how long you were enrolled, and whether you're still earning income. Now, you may be wondering how to check your own pension status. There are 2 important ways to do this. First, there's Nenkin Net, an online system where you can check your pension information. You can register and log in through the Japan Pension Service website. More importantly, you should receive what's called a Nenkin Teiki Bin, your annual pension statement. This arrives every year in your birth month, and it contains crucial information about your pension status. Let us explain what you'll find in this statement. In box 1, you'll see your total contributions to date, broken down into different categories: national pension, employees' pension, and different types of employees' pension if you worked in public service or private schools. Box 2 shows your total number of contribution months. This is particularly important because you must have at least 120 months of contributions before you can receive any pension payments. Box 3 shows what you've actually received in pension payments, if you were eligible now. It breaks this down into the basic pension amount from national pension and your employee's pension amount. There's also a second page showing your monthly payments over the past year. We strongly recommend checking this statement carefully when you receive it to ensure all your contributions are being properly recorded. Now, let's discuss the disability pension system. First, we need to explain what qualifies as a disability for pension purposes. The system recognizes 3 levels of disability. Level 1 covers the most severe disabilities, conditions like total blindness or complete paralysis that significantly impact daily life. These receive the highest level of benefits. Level 2 covers significant disabilities, such as partial blindness or major mobility issues that seriously affect your ability to work and carry out daily activities. Level 3 is only available under the employee's pension system, and this is a crucial difference. This level covers less severe disabilities that still affect your work capacity. Under national pension, you would receive, in grade 1, 1,020,000 yen per year. In grade 2, 816,000 yen per year, plus an additional amount for dependent children, 234,800 yen each for your first and second child, and 78,300 yen for each additional child. But under employees' pension, the benefits are calculated quite differently. They're based on your average salary during your insured period. Your years of contribution, with a minimum of 25 years used in the calculation, and the number of dependents you have. This typically results in significantly higher benefits than the national pension system, particularly for grade 1 and 2 disabilities. This is another example of why proper enrollment in employees' pension is so crucial. It provides much better protection if you become disabled. Now we'd like to explain about the survivor's pension and show you another significant difference between these systems. Under national pension, it's very limited. The benefit is a fixed amount, a maximum of 816,000 yen per year, and the eligibility is quite restricted. Only spouses with children under 18 can receive it, or the children themselves if they're under 18. That's all. No adjustments for your income or how long you've contributed. This is the basic amount. But look at employees' pension. It's much more comprehensive. First, the amount is calculated as 75% of what the old age employee's pension would have been. This means your family's benefit reflects your actual career earnings, and many more family members can qualify. Not just spouses with young children, but also spouses without children, children under 18, and even parents, grandparents, or grandchildren if they depended on you financially when you passed away. This is a very important difference. Think about it. Under national pension, if something happens to you, many family members who might need support would get nothing. But employees' pension protects your whole family much better. This is another reason why being enrolled in employees' pension when you're eligible is so crucial for your family's future security. Now, we want to explain about what happens if you leave Japan, what we like to call the datai ichiji kin, or lump sum withdrawal payment. This is important information for those who might return to their home countries. For national pension, the calculation is quite straightforward. It's based on your premium amount for the last fiscal year multiplied by 0.5, and then multiplied by the number of months you used for calculating your payment amount. For employees' pension, the calculation is different. It's based on your average standard remuneration during your insured period, multiplied by a payment rate. The payment rate is calculated as 18.3 multiplied by 0.5, then multiplied by the number corresponding to your insured period. But there's something very important we need to emphasize. The amount you get from this lump sum withdrawal is usually much less than what you would receive if you kept your pension until retirement age. Some countries have social security agreements with Japan, which means you might be able to receive your Japanese pension in your home country. In these cases, it might be better not to take the lump sum payment. You can find detailed information about this in multiple languages on the Japan Pension Service website. Now, before we wrap up, let me address some common questions that often come up about pensions. These are important points to understand, so please listen carefully. First, many people ask, can I work while receiving my pension? The answer is yes, you can work. However, it's crucial to know that your pension amount may be reduced depending on your age and total income. For example, if you're under 60 years old, your pension will be reduced if your combined monthly income from your salary and pension exceeds 280,000 yen. The thresholds are different for those aged 60 to 65 and for those over 65. Another common question we receive is about kara kinken. What is that exactly? It refers to periods that count towards your pension eligibility, even if no actual contributions were made. For example, if a foreign worker from France contributes 7 years in Japan and then returns to France for 3 years, that 3-year period in France could still be counted towards the 10-year eligibility requirement in Japan, thanks to social security agreements between the countries. The pension amount itself is then calculated based on 7 years of contributions made in Japan. As for transitioning between the two pension systems, remember that switching from employees' pension to national pension must be done individually at the city office. But moving the other way, from national employees' pension, is handled by your employer when you start the new job. Lastly, I want to mention that yes, you can absolutely receive your Japanese pension even if you live overseas. The process involves notifying the Japan Pension Service of your address change, registering an overseas bank account, and submitting an annual proof of life certificate. Just keep in mind that your pension payments may be subject to Japanese withholding tax, though this can be reduced or exempt in some cases depending on tax treaties. These are just a few of the key pension-related questions we often receive. As you can see, the system has many nuances, and it's crucial to understand how these differences can impact your specific situation, both now and in the future. Please don't hesitate to reach out to us if you have any questions. You can find our information and ways to contact us in the description below.